Hi, thanks for joining us today for this webinar called Tops and Bottoms. We'll go for a couple of hours, perhaps a little bit longer. And so be sure to ask questions as we go along. I can see your questions here on the screen here, and so ask the questions as we come. Don't wait till the end, because it's better to ask when we're going forward, so that I can refer to charts or what have you as we're going along. Also, for those of you in the U.S., this is just our standard disclaimer that trading is risky business, and certainly we can't take responsibility for your trading results. This is an educational seminar. And so be sure to consult a certified financial advisor before making any investment or trading decisions. Okay, let's talk about what we're going to cover tonight. Enough from the somebody from the Netherlands. Hi, Roy. Nice to see you. Okay, we're going to do a thorough discussion of tops and bottoms tonight, and we're going to do this from a Wyckoff perspective. Okay. I'm sure that there are other methods out there that are good, that produce good results, and that highlight tops and bottoms very nicely using indicators and that sort of thing. But we're just going to look at price action and volume, and that's it. And as I say, from a Wyckoff perspective, we're going to look at a couple of conceptual schematics, one for tops, the other for bottoms, so that you've got a picture in your mind or an image in your mind of what to look for. Okay, and as part of that conceptual schematic, we're going to look at the structural characteristics of tops and bottoms, and also the behavioral elements of them as well. These are the key items in this presentation. Okay, the structural characteristics and the behavioral characteristics. We're going to look at lots of examples. You're going to know them really well by the time we're done, but pay attention to these. This is what's important. Okay, this is what's important. And as we go through, I'll start with some very classic kinds of tops and bottoms where everything, all the key elements and characteristics, both behavioral and structural, can be seen. And then we'll show some that are a little more that are, let's say, less complete. They don't have all the elements or all the structural characteristics, yet are a valid top or bottom nevertheless. And we'll take a good look at those, okay? All right. We're going to also look at, this will be fun, we're going to look at some recent tops and bottoms, the major ones, all right? The 2007 top, the 2000 top, the 2009 bottom, the 2003 bottom. There's a lot we can learn when we start to apply the structure and behavioral characteristics from our concept, from our schematic, to the major tops and bottoms. We can see this stuff. Okay, we can see it very clearly, very plainly. We're also going to talk about something called upthrust after distribution. This is fairly rare. Well, I shouldn't say it's rare. It's just not that common. And I suppose rare is the opposite of not common, but it's a little bit more common than rare, but it's not particularly common. But when we see it, it's a pretty distinctive look of the market, and it has some pretty distinctive implications, and you need to be aware of it. Okay? And as we go through and we look at these, including the recent major tops and bottoms, we're also going to look at, right at the end, we're going to look at the recent intermediate bottoms in the S&Ps. We've been in this long uptrend since the bottom of the bottom of the market in 2009. And we haven't really had many big pullbacks here. We had really two in all of this. One was the flash crash, which was over in a very short period of time. And the other was the downgrading of the U.S. credit bonds and government credit. we're going to look at the latter. We won't look at the flash crash tonight because I've done that in other webinars. But we'll look at the credit devaluation, and you're going to begin to see, as we go through all these examples, that patterns are going to emerge, and these patterns are based on market behavior. So they're not going to change. They're always going to be there. They're going to come in different flavors. They're going to have a little bit of a different look. But if you know what these patterns are based on the behavioral elements and the structural characteristics that we're going to talk about, they're going to serve you very well in the future. Okay? We're going to talk about entry ideas. I'll show you different ways to enter. We won't spend too much time on this, but I'll give you a good indications on how to do this. We're going to look pretty good at the Weiss wave, because it adds a lot of value because it measures two of Wyckoff's three laws. Does anybody know what the three laws are, by the way? What are Wyckoff's three laws of the market? And this is something you all ought to know because it's really important. All the market goes around these three basic laws. Yeah, demand versus supply. That's right, Rama and CK, good. Cause and effect, CK says, and effort versus result. That's right. And now everybody's typing in. And we've got a packed house here tonight too, by the way. I haven't done a webinar in quite some time, and it's nice to see that people still remember us, even though we haven't been too active on the blog or on the website. We'll talk about that at the very end of the evening. But yeah, effort versus result, supply versus demand, and cause versus effect. And we'll talk about those tonight. But the Weiss wave covers two of those. It certainly measures supply and demand extremely well, and it also measures effort versus result extremely well. And we won't talk about this tonight, but if you really get into the guts of the Weiss wave, it actually, in fact, does measure cause and effect as well, although not quite as useful as other ways of measuring it, like a good point and figure chart. But the Weiss wave will give us some good information on understanding tops and bottoms. We're going to also look at a topic that's really important, and that is seeing tops and bottoms on multiple time frames. And we'll look at that towards the end of the presentation. Now, if you haven't thought about this before, or if you're unfamiliar about how to think in terms of multiple time frames and see markets in terms of multiple time frames, then I guarantee you that this will open your eyes. And it certainly will be helpful to everybody in trading the tops and bottoms more effectively. And as we do that, we're going to look at bar by bar chart reading as well. Something I always like to do, and something you really have to do. Even with the Weiss wave, which kind of amalgamates the market in terms of waves, you still need to be able to read the bars. It's absolutely critical that you be able to do that. So we're going to touch on that in some detail tonight as well. And then finally, people always ask this, does this work on Forex? Does this work on cocoa? Does this work on silver? Does this work on stocks, and so on and so forth? And the answer is yes. Any freely traded market on any time frame. So we're going to look at different markets tonight, and we're going to look across different time frames. Okay, so that's quite a bit to cover, and I just want to kind of press through, because I know that I get kind of caught into discussions and thoughts and tangents and stuff, and I start to forget about the time, and suddenly we're going a lot longer than what we should rather. Okay, so here's a conceptual schematic on a top. Okay, and let's start going through this so that we start to get familiar with this. So the idea here is that tops and bottoms kind of repeat themselves. Again, it's not exactly the same all the time, but what we see here is first of all, a top doesn't come in until the trend is mature. Okay, it doesn't, if we're just breaking out of a trading range, we're not looking for a top to occur. Okay, we want to see this occur in a mature trend. All right, what we're also going to see is that, not in every case, but in many cases, that the trend begins to accelerate its angle of ascent. We'll see exactly what that means, but you'll start to see that the market buyers get even more eager. This is the beginning of climactic action, where buyers, maybe they've been sitting on the sideline listening to their buddies making a lot of money on whatever market it is that they're trading, and they're kicking themselves because they haven't gotten in yet, or they could have gotten in back lower, but they didn't do it because they were afraid, or they thought this or that. And the market's just going to the moon. And so you start to see this collective action on the part of traders. And the market is just one big, massive, collective group of similar people. And not to say that everybody's going to act the same at the exact same moment. That's kind of, that doesn't really happen. But enough people act in a similar way because of their psychology, because of their trading behavior, and because of what the market is doing. And we know this. We know this, and we've known this for over a century. And so that's what we're beginning to see when the market starts to accelerate its trend. Okay. So eventually the market becomes overbought. Now, not in every case does it become wildly overbought, but many times it does. And oftentimes we will start to see that the pushes up don't have the same kind of force that they did down below. And then we start to see the shortening of the thrust. And that's pretty much almost always associated with diminishing volume. Sometimes we see some pretty heavy volume coming in and shortening of the thrust. That would be an effort to try to rally the market or push it up higher. But that effort isn't really rewarded. So that's one of the laws, right, of Wyckoff, effort versus results. So sometimes we can see that. But generally, when we see shortening of the thrust, and I'll explain this in some detail on the examples, generally we see some diminishing volume when that occurs. Right at the top, we're also going to start to see weak price bars. They're going to close off the highs. They're going to close in the middle or on the lows. And that's going to start to, as I said, even with the Weiss wave, we have to be able to read the price bars. And this is what we start to see is that the price bars themselves begin to tell us that supply is beginning to overcome the demand. And we see that with weakness in the price action. We will then see a sign of weakness. Okay, and I'll explain what that is as we go along as well. Generally, it's a big wave down on a high volume. Okay, we'll see that. And as this is all occurring in here, we're going to see what I call a swelling of the volume in the area of the top. You're going to see much more volume coming in this area because lots of eager buyers, but professional traders, for the most part, understand that it's too risky to hold stock or commodities or whatever it is that is being traded. It's too risky to hold it at that level. And so they know that, and they begin to sell into all that buying. So there's an amplification, if you will, of the volume on the part of both buyers and sellers. But that's a key thing that we're going to see, this swelling of volume in this area. And generally after the sign of weakness comes in, which is going to be a swift move down on high volume, we're going to see one of two things. It's either going to come back up and up thrust back in here, and more frequently, or just as often, I suppose, we're going to see that lower high being put in. Okay. Sometimes we don't get the big wave down. We get an up thrust in here, and then we get the lower high. There are variations on this, and we'll go through a few of them as we go along. But the basic ideas are right here in this conceptual chart. Okay? All right. Bunch of questions or comments coming in. Darren says he got a lot out of the Trade Guider webinar last week. That's good. Good to see you, Lars. Can't hear a thing. Yeah, if you can't hear a thing, the sound is good. You got to re-log in. With sign of weakness in the background, does it always need to be a lower low? No, it doesn't always need to be a lower low. Sometimes it comes back in. Can you draw how volume would look in this case? We're gonna see how volume looks on individual charts. This is just going to be a schematic here. Okay, you'll see more as we go along. Okay, so that's a top. Here's a bottom. Again, we have a mature trend. We're not just breaking out from the down, from a trading range. That's indicative of the beginning of a trend, not the end of a trend. Okay, so we have to have a mature trend, and the trend begins again to accelerate its angle of descent. It becomes oversold. This is just a mirror image of the top. Things in the market are generally mirror images of one another. Tops generally take longer to form, though not always, but they typically take longer to form, especially major tops in the stock market or the S&Ps. They take longer to form than bottoms. It's harder for people to sell or sell short than it is to buy something. That's just the nature of people and the nature of traders. So there is a slight difference in that way, but there's so many different, there's so many times that the tops just come in quickly that it's almost hard to say that these days. It may have been more true in a couple of decades ago. Anyway, this is a mirror image. We become oversold. We often see shortening of the thrust, again with diminishing volume. And we start to see price bars not showing weakness, but showing strength. Buyers coming into the market. We'll take a little brief look at accumulation, and I'll show you how to read that in a few examples here a little bit later. And eventually we'll put in a higher low. We might spring the market. There are different options here that you'll see, but you get the idea. I forgot to mention that after the sign of strength here at F, we will either spring the market or put in a higher low. And again, just like on a top, we're going to see that swelling of volume in the area there of the bottom. Would I say that high frequency trading is making manual trading more difficult? No, not at all. I don't really notice much of a difference. In fact, I think the volume is better with the high frequency trading. And remember what they're doing, right? The high frequency traders are trying to buy the market and then sell it right back to you a couple of ticks higher. And what they're really trying to force you to do is to buy higher, right? The market's coming in, their algorithmic programs detect a market turn, and so they start to, they're really front running. If you haven't read Flash Boys, or at least looked at some of Michael Lewis's articles on that, on high frequency trading, you owe yourself to take the time to do that. It's a very good book. It's very easy to read, and it explains high frequency trading extremely well and exactly what it's all about. So you ought to take a look at that if you're not familiar with it. But it occurs in the Globex market. It occurs in the NYMEX. It occurs in all the markets because the exchanges make money off of it. So it's not going to go away. But it's not, over the bigger picture, larger hedge funds and investment companies lose money on it because they're forced to pay up for their purchases or sell down their shorts. For the average little guy, like us, I don't really think it matters all that much. Okay. Okay, so here's the top in crude oil, the recent top that occurred in late 2008 or mid 2008. You can see clearly that we're way overbought in here, right? No question about that. Well, remember we said the market also starts to accelerate, all right? I want to look at some of these elements here as we go in. Clearly, we're in a mature trend. No question about that, right? And this trend has been going along, and it's gotten overbought. But we're also seeing that acceleration starts to come in here, and we can kind of track that with trend channels. Okay, we were in a nice gradual sloping uptrend, very nice uptrend for quite a number of months, and then suddenly it starts to accelerate. Okay, everybody should be able to see that. Okay, and look, it accelerates even more and even more. As the top is coming into play, buyers want to get in on this. They think that oil is going to go. I think at the time there were people out of Goldman Sachs and other oracles of oil, I think they called them, said that oil was going to go to $2 a barrel. Well, if it's trading at 180 and $2 a barrel is 20 points higher, then that was that money could be made. So a lot of people were getting in on that. But that was the time when a top was most likely to come in. Okay, let's take a look at the top in gold. This was the 2011 top in gold. Now here, it's a little more difficult to see the acceleration coming in. And so we're going to shift over to a daily chart in a moment. But note here, I just marked this point on the weekly chart with A, and then we've got the top up here, right? And we're going to look at gold. Gold's a very good model for us. We're going to look at gold in some detail as we go through here. But you can see that we've got, here's A, that same point on the weekly chart. We're in that nice solid uptrend. Then it starts to accelerate and accelerate. Okay. Now notice here too, let me just catch up with my notes. I have a tendency to do this. I just kind of go along and forget about what I want to say here. Yeah, so we can, okay, here we go. Here's the note. So we can see the acceleration much more clearly on the daily chart than we could on the weekly chart. And that's often something we're going to want to do. And this is kind of the beginning of the idea of multiple time frames, okay? So we can easily see that acceleration and the climactic buying that's taking place. Look at each thrust up here is pushing, as the market pushes up, we see volume coming in here, right? And if we just kind of eyeballed this as an average volume in here, we'll do this a couple of times so you get an idea of how to do this. And we eyeballed in here an average volume. Well, you can see that this market, this volume is really starting to swell quite a bit. All right, we've got the highest volume on the chart, and it's actually this bar right here. It's not going up, it's coming down. This volume is downside volume. Okay? And then as we start to go up here, look at what volume does here. It comes down. So this is a classic climactic action where we're in a mature trend, it accelerates, we see the swelling of the volume, the climactic kind of volume, because everybody thinks that gold is going to go north of 2,000 here. And people were just flooding into this market. China was rip-roaring in its economy at the time, and people were thinking that, China wants all the gold in the world and there's going to be scarcity and so on and so forth. Well, here's our sign of weakness right here. That big move down, that big wave down. We're going to look more carefully at that in a little bit. But you begin to see this, and then we get a weak rally up. This is actually an up thrust here, and that was a perfect place to go short on a daily basis. And then we get an even bigger sign of weakness coming down. And the gold market hasn't recovered, really. It's not strong at all. Although we probably will still see some rally up. Okay, some more comments now. Okay, let's see. Would you say that, okay, I did that question. What is the psychology at the bottom versus top? Well, it's a good question, Bill. It's a question of greed versus fear, I suppose, right? But fear operates in both instances. We say greed, but it's really fear. I don't believe so much in greed as I do in the idea of we're fearful of missing out, fearful of not making the money. And so then we rush to judgment and get in. But you can consider it as greed if that's easier for you to think about. People want to make money. That's what trading is all about. And so they are, and they see the market going up. And as I said before, they hear their friends making money. When in 2000, when I was just starting to trade, I was working also in a medical center, and everybody was into the stock market. You know, if you went down to New York City, the cab drivers had laptops, and they were trading stocks between fares. And I remember nurses. There was a male nurse who said, "Boy, my kids are going to go through college and graduate school thanks to Microsoft." Microsoft was one of the hot stocks at the time. That was the dot-com boom. And they all got killed. They all got creamed. But they kept buying and buying. Even, they would buy this here thinking what a great buy it was. And on the bottom, it's fear. The fear that the market's not going to stop going down. And that, we'll look at some big bottoms that occurred, like in 2009 and 2003. And it's very scary about what's happening. And people get very panicked. And one of the ways you'll know, for example, when a bottom is coming in in the stock market, you'll see all of the you'll see the first stuff that goes usually is the cheaper stocks. And it's when the blue chip stocks, when the IBMs, when the Caterpillars, when the Boeing, when the GM, all of those stocks are being pitched over and sold. And when you see an acceleration of those kind of stocks being sold, you know a bottom is getting close, because people are taking good stocks now and they're throwing them overboard. Okay. Okay. Do I draw a lot of trend channels? Yes, I do. Although I must say trend channels are useful. They are not. As good as horizontal trend lines, in my judgment, in my experience. Just notice that we were talking about greed and fear, and in this case it's greed. Just notice how the buying, notice the overbought condition in this market, brought on by the eager buyers, and they're accelerating a very mature trend. This stuff can't be sustained. You might have heard about parabolic moves. Well, these are parabolic moves here. These are parabolic moves. Wyckoff used to call them hyperbolics. Big spread. It's as if the market suddenly was injected with a hypodermic needle of adrenaline, and it shoots up where it really shouldn't be shooting up. And that's another indication here of that kind of climactic action. All right, let's take a look at some bottoms. We're going to start with a small time frame in the S&Ps here. And again, it's the same thing. We start off kind of making lower lows and lower highs here, we start to accelerate that trend, and then it really gets going to the point where it gets oversold here. We can see a little shortening of the thrust. I'm going to explain shortening of the thrust in much better detail, but you can kind of see that, you know, we make a low here, and then a low here, and then a low here, and that thrust down, thrust, a little bit of thrust starts to shorten. And as I said earlier on, that the volume, this is a measure of volume here from the Weiss wave, excuse me, from the Weiss wave. And it, in my judgment, it is the only way to measure volume in the intraday markets. It can also be used on the daily and the weekly and monthly charts too, but on the intraday, this really is a really great tool. But you can see that the volume is getting less and less as the market is coming down and down and down, and it's not making as much of a thrust coming down. So this is selling, but it's not as forceful as it was, okay? And that's what shortening of the thrust to the downside indicates for us. So we get oversold, we get shortening of the thrust, and we get diminishing volume down there. And then suddenly the market gets very bullish. Hard to trade this, by the way. This is a 5.68 point move in the S&Ps on this time frame. On a smaller time frame, you might be able to see it a little bit more clearly and make a trade in there. All right, let's take another look at an intraday bottom in the S&Ps. This is the market I trade most, and so I'm most familiar with this market. And it's I think the best market to trade. It's the most liquid, that's for sure. So again, we can see that here we do get accelerating move down. It's a little bit hard to draw trend lines or trend channels on it to highlight it, but you can visually see that it's way, way oversold here, and we do get some substantial acceleration down, and we get that high volume, that swelling of volume that we tend to see on the lows. And then, so we, you know, if we look at the thrust coming down, we have a thrust here, we have a thrust here, and then we have a little thrust here, and an almost tiny thrust here, right? So we have that shortening of the thrust, and the volume just diminishes right down. Okay, the volume just diminishes right down. Just to play this out a little bit more, we see a sign of strength come into the market, a bigger wave up, if you will, a bigger move up, and volume picks up. We start to see bigger volume than we've seen in a while. Market comes back. We have kind of diminished volume coming in here. We look to try to buy somewhere in this range or this area, and then the market pushes on up. Not a super strong push up, but it pushes up nevertheless. This was probably a bit of damage done to the market. We run from, what are we, probably around 1970 down to, well, let's just call it 1955. That's 15, 16, 17, almost 20-point run in the S&Ps. More than a 20-point run, almost a 25-point run in the S&Ps. That's quite a run in the course of a day and a half or so. So that was a lot of damage done to the market. So, you know, we would also see this as a mature trend on this time frame. 25 points is a pretty good, very good run in the S&Ps. We don't see too many intraday runs like that. Okay, so mature trend, acceleration, can't really map it out in terms of trend lines, but we certainly get to see it. That swelling of volume, the shortening of the thrust. We start to see some, it's hard to see this because these are small, it's a little bit compressed in here, but we start to see some buying come in. We see a sign of strength, a little bit of testing, and then the market continues to push on up. Okay. This was last week. Yeah, it probably was last week. I try to make charts fairly current. We don't want to just look at old historic stuff. Okay. Now, not every top or bottom is readable. I know this is going to be hard for some of you to accept, and I know some people would just make every little effort to put in a trend line and say, oh boy, it's oversold down here. Well, that's not much of a trend line. I mean, a trend channel. It's hardly moving at all in here. And yes, there's diminishing volume, but I don't really see how to trade this, you know. This really, to me, just looks like one swift move down. And maybe if it came into some significant support, you could make a case in here. Sometimes we see that it moves down fast in the morning and in the morning period and hits some significant support. But I don't know that in this chart. So just looking at this chart here, I wouldn't be able to make a trade off of this. And so I wouldn't know what to do here with this bottom. It's a bottom, but where do you get in? I don't know. I think you've got a bottom that apparently gets put in. We've got some strength that comes in. We can see that in terms of the bigger wave up and the volume here. So I think the first buy point would be around here at A. I don't see anything else possible really, or practical, I should say. Certainly anything is possible. You can buy that if you want to, but I wouldn't know how to do that. I don't think it really becomes clear until A. There the market's changed, again, due to the high volume, the large up volume, and then on the reaction, just very small volume. You know, over here, we were really coming down with strong volume. And over here, it's just light volume. So the behavior of this market has changed. And A has some strength in the price bar. You can see it dips down and closes firm. I like that. It's a nice look to a price bar. It frequently indicates, when you can combine it with some strength in the background and diminish volume to the downside, this frequently indicates the end of a down move, and it's a good spot to make a trade right in there. Okay, some comments here. How about the bottom after A? The big, that's yeah, we just talked about this. That's right. That's the spot that would make sense for me to buy. But the green big volume equals the big red volume. Right, they're about the same amount of volume, right? Nevertheless, if this market were still in a downtrending mode, you would not see this kind of volume come in. You would not see this level of buying come into the market. You'd see it die out in here somewhere, and then start making a new leg down. And this volume would probably be, a lot smaller. So just because it's not bigger than it doesn't have to be bigger. It just has to show some strength, proportional. The damage shown by the red was quite a bit. Yes, it was, and it took the market some time to digest that. But notice that it's on its way here to move on up. An ABC retracement, yeah. Would this mean an inability to push? I'm not sure of what you're asking, where you're asking that question, the inability to push. Lars says, regarding the strength with high volume before A. High volume before A. I have difficulty seeing it as a single up wave because the internal swings in the start. Could you please comment on that? Yeah, it's just, the way to think about this is that the Weiss wave, which is on this chart, this is the wave itself and the wave volume. So they're set to a mechanical number. On this chart, it's set for 3/4 of a point. This is the S&Ps, the ES, right? The E-mini. So it's set for 3/4 of a point on close. So that will change the Weiss wave. All right, so here we start to move up, and you've got a wave down. It only goes for 1 bar. Okay, so that means that the difference between this close and this close was at least 3/4 of a point. It could have been 1 or 2 points, but it was at least 3/4 of a point. But then it flips, and so on this close here, it means that it was greater than, 3/4 of a point or more greater than the last close. So it comes up and then it comes down for a point and then it continues to move on up. So when it does that, and we don't have any significant waves in here, when we don't have any significant down wave, like this is a significant pullback. We've got a number of price bars here and we've got, a good wave down. So when we don't have that, I just kind of, in my mind's eye, I kind of add all this together. I don't, make calculations, but I just say, okay, this is one wave up. Okay. And you just do that mentally. You can't do it. You could increase the size of the reversal on the wave. You could make it 1.5 points instead of 3/4 of a point. And that's okay. You can do it that way. But now you've got a larger reversal. So in a lot of instances, that's not going to be great. So you really, it's the same thing of like optimization. You really can't optimize this. You have to learn how to use it as a tool, and that includes knowing its shortcomings. And this is one of its shortcomings. And every tool has shortcomings, right? It's not to say anything disparaging about David and his WiseWave. This is the best thing going, I think. But it's everything has shortcomings. So you just need to know what those are. And you need to be able to make adjustments. First large green volume really shows changing character of down move. Yeah, exactly. This would not occur if it's still in a big move down. What would the sign of strength look like if it was an effort versus result instead of sign of strength we see here? You wouldn't see it move up as much, and you wouldn't see this kind of acceleration here. This is late buyers getting in and pushing the market up. So there's demand in here. You wouldn't see that. If it were effort versus result, it would kind of die out fairly quickly, and you just wouldn't see the large move up and the kind of price action that you see here. Okay, good questions. Keep them coming. Although you're going to I'll keep you here late, unfortunately. All right, so let's shift now off of the intraday, and here's the 2009 bottom in the S&Ps. Now this is a weekly chart, okay? And again, what do we see? We see that acceleration of the trend coming down. We certainly see the swelling of the volume coming in, okay? And, you can see here, this is A. We get oversold down here. This was terrible. This was early October of 2009, or 8 rather. And this was when the buck was broken. When they broke the buck, in other words, money market funds no longer had a NAV of $1. They could now go under that for the first time in the history of all of this. That was very scary time. It was also around the time that Bear Stearns, I think, or Lehman Brothers, one or the other, was let to go down. But we're not talking about the fundamentals. It was just a very scary time. And this was, remember I said earlier that all the blue chip stocks would be tossed overboard? Well, this is where it happens, right in here. And if you go back and look at that historically, you'll see that that's exactly what happened. We also see that swelling of volume coming in. Look at the volume in here. We'll discount that, but look at this volume in here. I mean, just take the average and take the average of everything from before, right? You basically double in a very short period of time the volume going on. And again, a lot of selling. But somebody's in there buying, keeping this market from going down, okay? And we see it, the only place we can see it, you can't see it in the price bar. You can see it a little bit in the wide spreads, surely. But the real place to see this is in the volume. And so this starts to stick out like a sore thumb when you begin to look for it. And then notice the shortening of the thrust. Right in here, you can clearly see it. I mean, we made this low, then we made boom, look at that, and then smaller and smaller. And this is shortening of the thrust. And as we said, the volume tends to diminish when the thrust shortens. And you can see down here at B that, you know, our volume is quite a bit less than we were at A as we come down. Okay. So again, clearly a mature trend. We go from whatever this was, 1450 down to 550 in the S&Ps. My gosh, what a drop, right? That's a mature trend. We see it accelerate. We see it oversold here. Okay, these are all the behavioral characteristics. We see the shortening of the thrust. We see the swelling of the volume. We see the diminishing of the volume. This is the first sign of strength in here. Okay, that's the first sign of strength. And then we get the lower, the higher low. As I say, they come in different flavors. They have a different look. Can I show some recent Forex reversals confirmed by the Weiss wave? Yeah, we'll get to Forex. Don't worry. Okay. All right. So that's the 2009 top. Let's take a look at the bottom, rather. Let's take a look at the 2007 top. What do you notice here? What do we see here? We see the mature trend, right? But it just dies off, right? What happened to the acceleration, right? What happened to the acceleration? Well, let's look more carefully at this. Let's look more carefully at this. We're still on the weekly chart, okay? And we definitely are in a mature trend. This trend went on forever, from probably the 1987 low, or even before that, 82. Probably a 20-year trend up, right? Well, let's start taking a look at this and start to see what we can start to see. Well, first of all, here's a way to measure shortening of the thrust. It's a simple graphic. All we do is just draw a straight line up, and then at the swing highs, and I have them labeled here, we just draw a little crosshatch in here. So we have a swing high at A, and then it comes down. We don't care about it coming down. Now it comes up to B, so we can put that same level in here at B. It comes down. Now it comes up to C. And notice that the thrust from here to here has gotten less. From here to here. Okay? So we're starting to see the thrust shorten. Then we make one more high up here at D, and we got minimal thrust. So real shortening of the thrust coming up. Okay? So that's one thing to notice about this. We also notice that on this down move, we get quite a bit of volume coming in. And look at this down move here. And look at how big this move is compared to the previous moves. Okay? And look at all that volume coming in. That's your sign of weakness. It comes early in this. We don't get an overbought market. We don't get a buying climax. What we get instead is shortening of the thrust with significant supply coming in. Okay? And then it's followed by an upthrust, a weekly upthrust. Here's your short opportunity. And other ones occur too. Here on a daily chart, there's a nice upthrust. On a daily chart, I'm sure there would be an upthrust in here. There are other opportunities for this to occur, for you to get short. But the principles are what is important here. Okay, we don't have everything going for us. We got the mature trend. We don't have the climactic action and the acceleration, but we certainly have shortening of the thrust. We have swelling of volume. We have big volume coming into the downside. And look at even deeper into this, and you start to understand why I would use the Weiss wave and just think in terms of waves here. This is, you can see that on the move up to A and then to B, we've got some pretty good moves up, right? C, it starts to get shorter, and D, it shortens up. So the lengths of the waves going up get shorter. But the key thing here, and that's really important, no question about that. But what really drives this home is this down wave right here. Look at how big it gets. compared to the other down waves. We could even go back in time even more. Much, much larger on huge volume coming down. Huge volume coming down. Much larger than anything we saw before. Okay? And this set up the upthrust in here, where we come back up and notice that the volume diminishes on the shortening of the thrust up here. And that upthrusts, and as we're going to see also on bottoms, springs are in their own right signs of weakness and signs of strength respectively. So an upthrust is a sign of weakness. It doesn't have to be preceded by this high volume here and this big wave down like it is. That's just icing on the cake for us. Just on its own, an upthrust is a sign of weakness, and the reverse, the mirror image of an upthrust, is a spring, and that's a sign of strength. We'll see plenty of springs here as well. Okay, a bunch of questions here. What do you look for when you had a good rally and then in the overnight session it starts to move in a range? What's the things to look for then? Same stuff, right? It doesn't change. It doesn't change. It's the same things. To differentiate between shortening of the thrust that leads to an eventual sideways move as opposed to shortening of the thrust that leads to a down move, do we need to see the change in behavior? Yeah, we need to see the change of behavior either preceding it or after it. If that change of behavior doesn't come, and look at this big wave down, right, to the downside, and the volume is strong. Volume picks up on this. The volume goes down on the rally and up on the reaction. So there, that's confirming all of this in here. If it just went sideways, then we would have to think more in terms of an absorption kind of a scenario. We're not going to talk about that tonight because that's not really a top, but that is, you do have to pay attention to that in the case of an upthrust. So if you don't get satisfaction within a fairly short period of time, then most likely you're probably in an absorption where it's going to try to eat through whatever supply exists here, absorb it, if you will, and then rally on up from there. But in this case, there was no possibility, I don't think, of absorption unless the Federal Reserve was somehow going to step into that. And I just, that was quite a bit of supply coming into the market. Okay. Yeah, you really meant by sideways move absorption. Good. The last green line thrust up does not correlate to your graph on the left. This last green line here is this up wave right here. And it ends up here, and that ends over here. So this up wave really doesn't have anything to, the distance between here and here really doesn't have anything to do with this graph. This graph is measuring the swing highs and the distance that is created between swing highs. Okay? It doesn't dip down underneath here and measure this. So it's a different different measure of the same phenomenon. Just a different way of looking at it so you can see. Okay. Doesn't current market have the look of absorption versus a top? We're going to look at the current market at the end here. Is absorption at the bottom, or is it just accumulation at the bottom? Just accumulation at the bottom. Absorption occurs at the top. Okay, let's look at another market. I said we'd come back to gold because this is another great one to study. And I encourage you to study this stuff and find your own tops in the markets that you trade and your own bottoms in the markets that you trade and see if they don't comport to this kind of thing. So we've got, here we are, this is the daily chart now. This is that point from A. It's the same chart. We have that nice move up. We've talked about the matureness of the trend. We talk about the acceleration. Now I want to talk about the sign of weakness that comes into the market. And we see the shortening of the thrust again, okay? We go to this point, we rally up, we reach here, we have a little reaction. Now we rally up to this point here. We have a big reaction, and now we rally up just a small amount, and we get over to here. Okay, that's the measure of the shortening of the thrust. And if we put waves on it, you would have, you know, your waves kind of looking like this. And a big wave down. Okay, that big wave down. Just the other way of looking at this. But the key thing to note on this chart is the same sort of story that we saw in the top of 2007 in the S&Ps. And that is, we get this big wave down, and look at, we don't even need to see waves. Look at the volume coming in. This comes down, this all the way down here. This volume is this down bar right here. Okay? And then we get some strength come in on this day, and the market tries to rally up. But look at the volume diminish. We see the shortening of the thrust and the diminishing of the volume. There's your trade right there. And you get good confirmation of this on the very next bar. Goes sideways a little bit, but that ain't absorption. It just starts sliding down, and then bang, look at this, and volume comes into the downside. So very weak here. Very weak market at this point. And you can see that the patterns are similar, and they're similar because it's all about human behavior on a large group basis. And that's what we see. Okay, now here's the top in SPY or S&Ps in 2000. This was the time I was telling you before where the nurses were telling me that the Microsoft was putting their kids through college. No problem, right? Everybody's involved in the stock market. Well, here's the top in 2000. And again, we don't get way oversold. Overbought in the trend channel. We don't have a trend channel on here, but we start to go sideways. We have shortening of the thrust occur and all of that. But what I want to highlight for you is something called upthrust after distribution. Okay, as I said, it's not that common, but when we see it, boy, just notice it, because it could be the end of whatever market you're looking at in terms of the upside to it. So we see at A some very large volume coming in. You can see that buyers were eager, and we see almost a straight up move. Again, Wyckoff would call this hyperbolics. Markets generally don't move straight up like that, and especially at a mature trend, it's not where we would anticipate seeing such a big move up. And notice that when we do push up, and we do have some shortening of the thrust in here, look at the volume diminish here on the rally up to B. That's not bullish behavior, where we see huge volume coming in below the top, and then after the top is penetrated, volume dries up. That's not bullish behavior at all. Neither is we start slipping back down and we don't hold that last swing high over here. We slip down substantially. We close kind of off that's the close right there of this bar C. But boy, that's weakness. That's supply coming into the market, even though we do see a little bit of buying coming in the afternoon. That's a lot of supply coming in. So we start to see that swelling of volume. Market tries to rally up. It goes nowhere on no volume. There's just no fuel for this market anymore. And bam, it just gets slammed down. I hope you all can see that this is the biggest down wave or down move on this entire chart to that point. Okay, to that point. It's the biggest down move on the single down move. You know, compare them to all of these. It's the largest single down move on this entire chart. And look at how it just goes straight down. It just plummets. That's weakness. Okay? That's serious weakness coming into the market. So this is distribution. There was distribution going on in here. And we just go sideways for a long period of time, 3 months, from whatever, April to end of September. Now, notice this isn't distribution because we're not hugging those highs. We're not up near the highs. We've just had a serious sign of weakness. And That would be, if we rallied up in here and we held along in here and held this low maybe in here, that would be absorption, and then we would look to move forward. But we don't have that at all. We come all the way down to here. We retrace this last move down. Okay, what happened to all the buying, all the volume in here? Where did that go? Well, that is another clue. This move down here to D is another clue to us that this was what Wyckoff would call, or did call, buying of a poor quality. It's the average traders, the what do you call it? Did he call them weak hands, if I'm not mistaken? The weak hands coming in and buying because they think that the market's now, it's just breaking out above this level and it's about to go to the moon again. But a lot of selling is going on in there too. And so we come to a point where we move into this protracted trading range and we get an upthrust over here. And that's an upthrust that occurs after we see distribution. And this is our weakness. It's distribution as well, but all in through here and probably back into here is all distribution. In other words, professional money selling into, large operators selling into the market and building an inventory, either getting rid of their long positions and or building an inventory of short sales for an anticipated large drop in the market. We had that in oil intraday today. Yeah, I didn't see the oil market today. I was working on this presentation, kind of finishing it up. So here's the same chart or same period, 2000, right, on the weekly, and you can see that it's more dramatic on the daily. But what I wanted to point out is here's the distribution line in here. This is the distribution. If we looked at this on a point and figure chart, we would start to make a projection down. And then that would be expanded over to here. And we would project even lower. And somewhere down in here we'd get a good count for it. We're not going to do point and figures, but just to see that. And E is the point of upthrust. C is the sign of weakness. B is that weak rally. And you can't really see the volume that occurs in here because on the weekly, because it's dwarfed by the bottom down here in 2003. But you can kind of see that there's a lot more volume in here, that swelling of the volume. Certainly you can see swelling of the volume on the bottom here, right? That's pretty obvious. Here's a current, that's enough Asta. Here's a current stock. It's Medifast, MED. Hang on a second. Let me get Asta out of here. Go see. That's Mommy. Go upstairs. Hurry up. Get going. Go. Good guard dog, but he gets nervous and doesn't want to go up. Okay. So this is Medifast, or MED. It's on the New York Stock Exchange. This is as of today, I think. This is a weekly chart, or as of a couple of days ago. You can see one of those accelerating moves up. Hard to read this on the weekly. We'd have to drill down into a daily chart to see whether we could make anything out of it, whether we could make any acceleration and overbought characteristics out of it. I assume we could, given these kind of large price bars in here. And it gets swamped by this bar, and then talk about swamp. Look at the volume, my gosh, on this, right? And we come up here and we upthrust it at B. And even on the, even here you can see that there's some volume coming in. And now we've gone all along for several years here, 2, 3, 4 years since the high, but we can't get out of this supply. Okay, we can't get out of this supply. This weakness down here is still affecting this market. And so we have the potential for an upthrust after distribution of a long period of time occurring. And, you know, if this is true, we need to make a projection here, but we're looking at this would be a first target, and potentially down here would be a second target, depending on what the count looked like off of this. But this is a potential, is something to watch, you know, or you can trade it if you want to, but at least we can watch this and see how it unfolds. Guard dog sounds like he's a puppy. No, he's 4.5 years old, but he's a good pup. Okay, so that's a live chart. Let's take a look at the 2003 bottom in the S&Ps. Clearly a mature trend. We are we have, you can't quite see the acceleration down here. We're going to look at the daily chart in a second. We'll see it then, but you can kind of get an idea that we're accelerating down. We are certainly oversold in the trend channel. We're not wildly oversold, but we are getting oversold. We see the swelling of volume in here. Once again, look at this in this area. Just take an average in here, and it dwarfs whatever existed before. We see also the strength coming in the price bars here. Okay, the strength coming in the price bars. We don't actually have a sign of strength in here yet. We do on the daily chart, we'll see that, but on the weekly we really don't. That doesn't come in until really into here on the weekly chart. And keep in mind that the you know, when we're looking at multiple time frames, the daily chart is going to turn and show more than is going to turn quicker than the weekly chart, and it's going to show more than the weekly chart, because we're able to drill down. And it's the same thing if we were working on an intraday time frame and looking at the hourly as our sort of trending time frame, or the one that we focus on most, and then we're looking at a 15-minute or a 5-minute or a smaller tick type chart. It's the smaller time frame that's going to turn first, and it's going to show us the details of the higher time frame. So we can see here that on the daily, the same area now, this is the same area as the weekly. I'll just go back quickly here. A, B, and C on the weekly, and that shows as A, B, and C on the daily here. A, B, and C on the daily. And we've got the acceleration in the trend. We've got the humongous volume coming in. This is climactic action here. We actually have a spring at B, and as we came down, the volume started to diminish down here. On the rally up off of the spring, we get strong volume and we get strong price action, including gaps, because this is SPY, so we would get that. But nice price action up, showing that this is a sign of strength. So we have stopping move here, we've got a stopping move and spring here, we have a sign of strength here, right? And as we come back down, we're holding a higher low, and that's marked by a spring. This is very similar to the upthrust after distribution. This is like a spring after accumulation. Okay, maybe you call it a spark or something. A spring after, or a SPAC, I guess. It's not, there's no R in there. So, spring after accumulation. Bob Evans was the one who talked about upthrust after distribution. He never talked about springs after accumulation. I don't know why. But you can see here there's a nice spring. And notice that it comes back into this area here, this buying area, where they were buying. That was heavy buying going on. It comes back down, dips into that area, and we spring we spring that, and then we get, you can see the volume coming in, a sign of strength here off of the spring. And remember, springs by themselves are signs of strength, but we want to see the sign of strength occur after the spring as well. Otherwise, they may not be valid, okay? Especially if we're buying a spring in a downtrending action. What I'm showing you is how to override that. Springs are normally not a good buy or a purchase in a downtrend because they fail a lot. Just eyeballing this chart, we're making a lower high in here, and this is not a great spring, but there is a spring here. But notice we don't get, see how the action is here? We start to immediately roll over. Compare that to this action here or this action here. We get immediate gratification to our long position. That's one of the characteristics of a great spring. And I love springs. I'll buy them almost any time, as long as they're not in a beginning in a downtrend. Can I clarify the difference between stopping volume and climactic action? Not really. Stopping volume is I think it's a term used. Climactic action would be, the mature trend, the acceleration, and then the humongous volume that we get. So this would be climactic action. But it stops the market. So they both do the same thing. It's a sudden increase in volume in a down move. This is a stopping volume. A sudden increase in volume on a down move that shows buying coming into the market and stops the market. Here's a quick example of what we might call stopping volume. That's the volume there. We're in a down move. It stops the market. Market tests it a couple of times. We move up to some degree, but then start coming back down again. But that would be stopping volume. So the main difference is stopping volume is sort of like a small climax. Wyckoff called them climaxes. I don't know where stopping volume came from. I think Tom Williams, if I'm not mistaken. Seems like that entry on the last weekly chart was a potential spring. Yes, it was. It was. This is daily chart, though, right? The weekly also has that spring action here, okay? And we have a spring in this on B as well. So only trade springs in uptrends and after accumulation. That's what I would do, Roy. Difference between a spring and a springboard. Springboard is, we'll see a couple of examples of springboard. I'll show you what that means. Okay, see you, Scott. Scott's got to take off. All right, so we're at least an hour into this now already. Does everybody want a break? We're a little less than halfway through, so we probably ought to take a break, if not now, within 10 or 15 minutes. Yes or no? Would you like a break? Okay, I think the yeses have it. Some folks say no, but most are saying yes. Okay, let's take a short break.